So in Chapter 9, we get into flexible budgets and performance analysis. And this leads us into the next chapter, 10, where we talk about variances. So in this chapter, we're just kind of getting used more than anything to the terminology. And there's a lot of exhibits in the chapter that you're going to want to refer back to. And this first problem that I'm going to look at, I'm actually going to look at Exhibit 9-6. And this is an activity variance report. And with these, you have flexible budgets, you have planning budget, and then you have activity variances. And so we set them up that way, and we look at our variances. And as I said in the introduction to this week, it's favorable and unfavorable, but it doesn't necessarily mean good or bad. And so we want to be careful that we look at it that way. And what we're looking for is variances that are large, that are significant, and we are investigating why we have those variances, like what caused it. It could be a favorable variance and be bad. It could be unfavorable and be okay. And so we're looking at it that way. And so I'm looking at a flat cafe. So we're going to start with budgeted meals and give you the information. We have revenue, we have expenses, and in those expenses we have raw materials, and I'm going to add a column here in a minute. We have wages and salaries, sometimes I need to just start over. Wages and salaries, we have utilities, we have facility rent, we have insurance, and we have miscellaneous. And so as we go through these, we want to look at how they're set up, how these expenses, are they fixed, are they variable, are they mixed? Is part of it fixed and part of it variable? And so we want to look at it that way. And so oftentimes you will see another column. And in this column we'll have the per unit information. Now you don't always see this, but often you will. And I'm going to go ahead and set it up this way so that we have the information in front of us to talk about. Now, wages and salaries, this is a perfect example. This one is partially variable and partially fixed, and there's my variable part, and my fixed is $5,200. And remember, these are internal reports, and so there's no generally accepted accounting principle on how we set these up, because it's something we use internally. We wouldn't want our competitors to know what's going on with our budget. Our facility rent is fixed. And I probably want to define these or label them a little bit better. Definitely would if I was working on this. And so I might even come over here and insert another column, make it very small, and then note on these if they're variable or fixed. And then for some consistency, we'll go ahead and set it up that way. Okay, and so that's just information we need. And then we could go ahead even up here and set up our number of meals and kind of make it even better and more self-explanatory for the reader. Okay, so our budgeted meals were 17 was actually served. 17,800 were actually served, and so I'm going to put actual right there, which if you're reading a flexible budget, you know that is actual, but I'm going to put it there just for our benefit. And then my planning budget, I'll go ahead and put what we planned to do was 18,000. What we did was 17,800. So we want to, when we compare our actual with our budget, we want to make sure that we're comparing the right numbers. And so my flexible budget gives me actual revenue, and then my planning budget gives me what I had planned for my revenue. So 80,100 is my flexible. My planning is 81,000, and my variance, the difference between the two, or $900. So is that favorable or is that unfavorable? So that's what we're going to put over here is an F or a U. Is it favorable? Is it unfavorable? Well, we had planned to bring in revenue of 81,000, but we brought in revenue of 80,100. So is it favorable or is it unfavorable? And when revenue is less than we expected, it's unfavorable. So you can't say higher or lower. You've got to be careful with that. Okay, so then I've got my flexible budget, and I can go ahead, I think, and set this up where I can fill these down, at least for my variables. So just ignore my fixed for now. We're not going to. Okay, and then my fixed, those don't change based on my activity. And so I can go ahead and just enter those. I actually probably should be entering cell references so that if we go back and change any of our budget information, it's there for us. And then my total expenses, put those right here. And then my net operating income based on my flexible budget is my revenue minus my total expenses are $14,490. Now this doesn't mean actual, this means flexible. So it's my budgeted numbers right here based on my actual meals. So make sure you catch that. We're not comparing the actual yet. And so my planning budget, I would multiply that times each of my variable amounts, and I would have my, and I'm going to go ahead and fill this down and then do the same thing and delete my fixed, and then I have my cell references for my fixed cost. I can carry those down. And then my totals. And then my planning budget, what I planned to have for operating income was $14,820. What I had was $14,490, so a little bit under. But we're going to go back up here and look at our variances. And so the difference between our planning budget and our flexible budget, whoops, I didn't do that right. There we go. And we don't really, general practice is we don't show these as negatives or positives. We show them as favorable or unfavorable. So if our raw materials we thought would cost $43,200, but they really cost $42,700, then we have a favorable variance. But why is it favorable? Well, it's because we sold less than we thought. And we have the same thing for each of these. These are expenses. And so when we come down here to our net operating income, we also, I'll go ahead and carry that down, have a variance. This would be favorable, but this is unfavorable because we projected a net operating income higher than what we had. So how can we have all these favorables and then have an unfavorable here? And it's because, this kind of throws you, I'm going to take that off. It's because this is an unfavorable revenue, which is more than all our favorable expenses. And so that's why you see it that way. And so this is kind of what it looks like. Now we could go a step further and we could do actual and compare that, and we'll get into that more in the next chapter. There's Exhibit 9.8 in this chapter would be a good one for you to look at to review when we compare actual. But I really wanted you to see the flexible and the planning.